Today I want to discuss a dividend stock that is yielding 5.5%. This is a dividend stock that everyone out there in the community, the dividend growth investing community, seems to be talking about. It's a stock in the comments section of my videos here on YouTube, gets picked up, gets discussed quite a bit. Today I want to analyze AT&T, ticker symbol T, from a dividend growth investing perspective, and I want to give my personal opinion on this dividend growth stock. Hey everyone, Ian here, ppcian.com. It's 2018, and this year so far I have received so many questions about AT&T and the alluring yield of 5.5%. That's quite a nice yield, a nice starting yield, and so the dividend community is talking about this stock. I'm getting a lot of questions about this stock. A lot of people are talking about this stock, and so I wanted to take some time today to analyze this particular company. At a high level, I do not own any shares in AT&T, and there are a few reasons why, and so I want to share throughout the video today why I personally don't own AT&T in my stock portfolio, but there's some pros and cons with this one, so I think it's going to be a really interesting analysis. I want to start out today with the most important thing from a dividend standpoint, which is the dividend and the dividend yield. I invest for dividends, I invest for cash flow, I invest in dividends that can pay for my living expenses, and one day they will pay for all of my living expenses. And so a company like AT&T that is paying a dividend of $2 per share at a 5.5% yield. I just take the $2, I divide by the current share price of $36.87, I get 5.5. 5.5% in this market is a really strong starting yield. It's a great yield, and it's one of the things that I think attracts so many people to AT&T. Put another way, if I invested $1,000 in AT&T right now, I would receive $55 per year in dividend income in my first year, my first 12 months, and then it would go up from there as the company raises its dividend over time. And so that is enticing. Let's look at the dividend growth. If I go back to 2014, they paid 46 cents per quarter. 2015, 47 cents per quarter. 2016, 48 cents per quarter. You can see the trend here. Typically, over the last number of years, it looks like AT&T each year raises its quarterly dividend by 1 penny. When I take that 1 penny and I divide by their quarterly payout, it's about 2%. It's about 2% dividend growth per year. This is not very exciting to me. It's not horrible in the sense that at least they're growing the dividend. It makes sense to me because this company is a utility. They are in the utility industry. They provide phone services. And so it's not a horrible dividend growth rate because a mature company like AT&T, a mature utility, typically the dividend will not grow very quickly. That said, I think it's very important for investors getting into this type of company to think about this. 2%, that is probably going to keep pace with inflation over the long term. So the way I look at AT&T growing the dividend yield at 2% per year is I'm getting in at 5.5%. And that purchasing power that 5.5% brings me right now in 2018, it's probably going to be very similar in the future. Even though the dividend grows 1 penny per year, or 1 penny per quarter per year on average, so there's 4 quarters in a year, so it's 4 cents per year that they typically raise the dividend, about 2% dividend increases year over year. That is probably going to keep pace with inflation. And so it's just important as an investor to be realistic in this regard. And that's okay. I personally own utilities in my portfolio. I don't own any telecom utilities, and we'll talk about why in a minute. I personally own some regulated electric utilities, though, and one of them being Southern Company, I have discussed in some prior videos. And I like utilities. One of the reasons I like utilities is they bring dividend income into the present. There's kind of two ways of investing for dividend income. There's one is starting with a stock like AT&T that has a high starting yield. Another one, by contrast, is to buy something with a lower starting yield but has faster growth. Personally, I like to balance the two, and so I like having utilities in my portfolio because if I was delaying all of my dividend income to the future and I only bought stocks with a low yield in the short run, what if I needed money tomorrow? What if I wanted to tap into my dividend income tomorrow for living expenses, or at least to supplement my income to pay for certain things? It's really hard to do that when the portfolio is completely weighted on future growth. And so it's nice to balance future growth with some present yield. And you're getting a lot of present yield with AT&T. But the fact of the matter is that this 2% per year growth on the dividend, it's probably just going to keep pace with inflation. And so it's really that 5.5%, in my opinion, is somewhat capped. The purchasing power, at least. The dividend yield on cost will go up over time, but it's really going to have a very similar purchasing power to what one is experiencing right now, in my humble opinion. So by comparison, and I think this is important, very important, take a look at Southern Company. Right now, Southern Company, it's a regulated electric utility. They have a starting yield of 5.25%, so a little bit lower than AT&T, but in a similar ballpark. I own Southern, I don't own AT&T. I won't be buying AT&T, and the starting yields are similar, but the reason I'm comparing here is they're both utilities. Yeah, they're different types of utilities, but what's interesting about Southern Company is they're growing the dividend about 3.6% per year. So even a regulated electric utility is able to grow the dividend quicker than this telecom utility. And so that's just something worth noting, is even, I know with Southern Company I'm trading dividend growth for present yield. I'm okay with that. I want some present yield, but the fact of the matter is even Southern Company can grow that dividend faster than AT&T, and that's just one of the reasons, quite frankly, that I personally stay away from AT&T. Not the only reason, but one of the reasons is this is pretty sluggish. And obviously it's to be anticipated with the utility, but it's even sluggish compared to utilities that I have become accustomed to. So moving on, let's look at the market capitalization. So AT&T is a very big company. This is a company with a $226 billion market cap. I like that. That provides some stability, some comfort. I tend to buy companies that are larger. I like large blue chip names. This is a household name. They've got multiple different divisions. They have not only domestically in the United States, but they're also expanding internationally in Latin America. I really like that. That's one of their fast growing divisions. And so the fact that they're diversified by business unit, the fact that they have a larger market cap, the fact that they've been around a while, I think they were founded in, they were saying 1983 or somewhere around then. I like all of those things. And so this is just worth noting, but something good. Here's where things start getting really interesting. I think a lot of dividend investors right now are having trouble acquiring the right data to make good decisions. And so, for example, I use Yahoo Finance. I go to Yahoo Finance, I pull my numbers. One of the most important numbers that I look at is the price-earnings ratio. This is the share price divided by earnings per share. Put another way, price earnings is how many years it will take to basically pay for the stock that I'm buying in terms of earnings. So if the PE is 10, it'll take 10 years worth of earnings to pay for the present price. High PEs mean a stock is more expensive. Low PEs mean it's cheaper. I like low PEs. I like a margin of safety. When you go to Yahoo Finance, it says right now that AT&T's PE ratio is a 7.74. I think a lot of dividend and value investors see something like that, and they are so excited. They love it. But guess what? That is wrong. That is not the PE. Typically, when I see something like that, it is immediately a red flag to me, and I'll start pouring through the annual reports, the quarterly reports, all of the data that I can get my hands on to get to the bottom of what's really going on with the PE. And look, I spent some time preparing for this video. I could not even get to the bottom of it. I'm sure I could if I spent more time, but here's what happened. So I just started looking at it quarter by quarter. I pulled this information. I was able to pull it from AT&T's quarterly report. And I was also, for the fourth quarter of 2017, I was also able to pull it from some other data sources online. NASDAQ, for example, has a really good website that has a lot of good data. I pulled it from there too. Q1 2017, they earned 56 cents a quarter. Q2, 63 cents. Q3, 49 cents. Q4, $3.08. That to me is why the PE is off. Wait, all of a sudden the earnings per share are $3.08. I knew the Q4 earnings per share were wrong. And so this is a tip to everyone out there. I get a lot of questions about this as well. You're on Yahoo Finance, you're like, why does this PE look wrong? Take something like that and just break it down. And so when the PE looks wrong, what I do is I break it down by quarter. What were the earnings the last 4 quarters? And I looked at it for AT&T and I saw, okay, Q4 something looks really weird. They're in the mid, 56, 63, 49. They're all kind of around the $0.50 range. And then suddenly in Q4 they earned $3.08. That certainly doesn't look right. And so anyways, I started digging into their financials. I started reading some of the literature that AT&T on their investor relations website provided to their investors. And I found that there's been a lot of tax reform lately. This tax reform is changing the way that they are accounting. They had some tax benefits. They appeared to me to be one-time tax benefits. And so their income got boosted. It got way boosted because I was looking on their income statement. And I've done videos on this. I'll link to it in the description below. I was looking at their income statement and they actually had negative taxes. They have negative tax consequence. They were getting money back, and so it boosts their earnings per share. Anyways, they also provided an adjusted number. Unfortunately, Yahoo Finance pulls the non-adjusted number, but they provide an adjusted number. And the adjusted number, instead of 308, they said they earned 78 cents. And so here's where it gets really weird. I added them up, 56, 63, 49, and then 78. I still didn't even arrive at the right number because when I was looking at AT&T's quarterly report for Q4, they tell me on an adjusted basis that they earned 305. When I add these 4 numbers, 56, 63, 49, and then the adjusted 78, I do not get 305. I get something lower. And so the fact of the matter is I will be waiting for AT&T's 2017 annual report. It's not out yet. I was just looking at the Q4 report. When it comes out, maybe I'll get more insights into this. But what I've decided to do is, even though the numbers don't add up, I'm taking it at face value what AT&T is telling me. They are telling me, Ian, on an adjusted basis, we earned 305. That's what we earned. Fine, so be it. If I take the current share price of $36.87, I divide by 305, I'm backing into a PE ratio of 12. It's not 7.74, it's 12. This is what happens oftentimes with PE ratios and with other metrics, and why it's so important as a dividend growth investor, a value investor, someone looking for the truth, real numbers to make decisions on, that one mines the data, one looks into the data, and sometimes they won't even find the answer. Like, I kind of have an answer here. I think the PE is 12, but it really could be something different. But I'm taking it at face value, even though my numbers don't add up, that AT&T is telling me the right thing here, and that the earnings per share on an adjusted basis for 2017 were 305. Again, there's a lot of weird stuff going on here, though, with taxes, and that's what's throwing it off. Not only for AT&T, but for other companies. But I'll tell you, just a side note on the tax situation. In general, the tax reform is helping a lot of these big dividend companies. I think it's generally a good thing for these big dividend companies. That being said, taxes change over time. Maybe with this presidency, the taxes will be one way, but when the next president comes around, maybe taxes will revert right back to where they were before. And so I don't like to bank a lot of my long-term prospects on taxes and tax reform. And so they're getting some benefits now, but you know what? Those benefits may go away in 10 years or whatnot, whenever the next president comes. And so because I invest for decades, I invest for 30 years or even more. I'm a forever holder. I buy and hold forever. I invest for the dividend stream, the dividend income. When I see something like tax reform and some short-term benefits, it just doesn't really skew my long-term vision of what things will be like 30 years out. And so, with a PE of 12, though, let's take it at face value. Hopefully I've backed into the right PE here. I'm not 100% confident, but it looks a lot better to me than 7.74, a lot more accurate. Look, a PE of 12 is reasonable in this market for a company like this, for a utility. Most utilities now are in the mid to higher teens, and so having a utility in this range, that's not bad. That's a reasonable starting PE ratio for any company in this market. That being said, I personally, if I were ever to buy AT&T, I just don't personally see myself wanting to pay more than a PE of 12. This is one of those companies where they just don't have that proprietary secret sauce. They just don't have that brand. They don't have that cachet with the customer. They don't have that world-class blue chip consumer-driven brand that I see warranting more than a PE of 12. It's a nuts and bolts company. They are providing a service. They are not regulated. You look at something like Southern Company, they are regulated. If you live in a state where Southern Company operates, you are buying your electricity from Southern Company. And if Southern Company needs to raise the price on you because interest rates are going up and they need to refinance their debt, they will work with the government and they will raise prices. And the customer has to pay the higher price because it is regulated by law that that's where the energy is coming from. By contrast with AT&T, they provide infrastructure for one to communicate, whether it be their traditional landline, their mobile phone, the cellular network, whether it be they own the direct TV division, they're providing television services. If someone is unhappy with AT&T, they can go with a competitor like Verizon. They can go with another company. Maybe for their television services, they're unhappy with DirecTV. Maybe they go with Comcast with Xfinity. And so there are many choices. It is not regulated. Yes, surely not all of these companies operate in all of the same territories, but more or less there is going to be choice. And so for an environment where they are providing a nuts and bolts type of service, there is no real brand benefit, and there's choice because it's non-regulated by the government. I would say that a PE of 12 is about right. Certainly, just my own personal opinion, going above a PE of 12 would not make sense for me if I were ever to buy this. But it is not a stock on my personal watch list. And these are some of the reasons so far, but we'll go on and share some more. So next what I did is I looked at revenue. Top line growth is going to be important for any company in terms of sustaining its dividend growth. They've grown their top line pretty nice. So this is something I like. 2012, it was 127 billion, up to 163 in 2016. 2017, it went to 160.5, so it dipped a little bit. Revenue softened a little bit in 2017 versus 16, so might be a warning sign. That said, as a long-term investor, I don't look at like one year, down year as a bad thing. I look at the bigger picture. And so by being up between 2012 and 2016, revenue by 29%, that's pretty good. And I think that for them to continue to grow, I think the international markets are going to be key. That Latin America exposure and hopefully more global international presence is going to be big because that's where a lot of the mobile phone usage is. I think mobile phone usage in the United States, I don't know when it will saturate, but probably at some point, and so they'll need to expand outwardly. Anyways, that's good revenue growth. But check this out, debt. If I look at debt, and I didn't pull it for 2017, but I pulled it for 2012 through 2016, their debt in 2012 was $69.6 billion. 2016, it went up to 123.5. This is an increase of 77% in 1, 2, 3, 4, 5 years. Their debt is up 77%. This is a little bit alarming to me. They're carrying $123.5 billion worth of debt. Interest rates are at historical lows. We already know that interest rates are going up. They will have to refinance this debt. This refinance and this interest cost, this cost of carrying this debt could potentially squeeze margins, and it could squeeze their ability to, they're going to keep raising their dividend 1 penny because that's easy, and they're doing these small 2% a year increases, so they'll probably continue to do that. But if the investor ever had a hope of seeing more than that, I think a lot of that hope could potentially be at risk because of the huge cost of servicing this debt. And this is what I don't like personally about, I would say, utilities in general, but I do own some utilities, but telecom companies in particular are even different, I would say, than electric utilities, is the technology keeps changing. These companies, first it was 3G, then 4G, then this, then that. They're always innovating, and the networks have to get faster. They have to compete. It's not regulated, so they have to potentially compete on price, compete on brand. And look, brand loyalty with a utility is generally not going to be very high like it would be with a consumer staple, consumer non-cyclical company. So just think, like, what do you think about your local electric company? Do you love them? Do you hate them? In many markets, electric utilities are regulated, so even if you dislike them, you're going to have some brand loyalty to them just because there's no other option. But with your telephone company, do you love them? Do you dislike them? I would say net promoter scores in this category, meaning the likelihood of someone to recommend a telecom utility to a friend, that's a Net Promoter Score. How high are Net Promoter Scores in this category versus maybe a consumer staple brand? They're probably lower if I had to guess. I didn't look at the Net Promoter Score, but I'm just saying there's probably not a huge amount of brand loyalty to a company like this. And so anyways, debt service potentially going up with rising interest rates, choice out there on the consumer side, and probably not a lot of brand loyalty. Gonna have to compete on price potentially. This could squeeze margins. That said, not included on here, I did look at their margins very quickly, and their margins do appear to be pretty strong. They have strong margins, so there is room for shrinkage there. That said, these meta-level factors are something that potentially concerns me. Something else worth mentioning on a utility like this. With electric utilities, everyone is going to need electricity. We have, during the winter time, we need to run our heaters. During the summertime, we need to run our air conditioners. We need to plug our electronics in and charge them up. And a lot of people are moving towards battery-operated cars, electric cars. Well, they need to be batteried in and powered up. And same with one's washing machine, washing clothes, having the lights on. People generally need electricity. Now, one can go ahead and convert their home to solar, but that said, the cost of converting to solar is quite high. Also, one may power their whole house on a battery, but that said, that battery needs to charge up somehow, and maybe it's solar, but look, there's only so many people that are going to do that. And quite frankly, a lot of people live in apartment buildings, and are apartment buildings going to be able to power the entire community on solar? Probably not. So the way I look at it is there's going to be a need, looking even 30 plus years out, for electric utilities. Company like AT&T, I'm not trying to be doom and gloom here, but what if a company like Google comes along and says, okay, I'm going to offer free internet to everyone. Everyone gets free internet. Don't pay for it anymore. It's 100% free. This is something that might sound crazy, but I wouldn't be surprised if this happened at some point. These disruptive tech companies, they have very long-term vision. They're thinking about the long term. They're very much playing a game of chess versus checkers, and there could be reasons that they would want to do something like that. And so it's just something to look out for on the horizon. So what else about AT&T? Now, this is what I wrote down here. There's a few things I jotted down in my notebook. One thing I'd say that I think is important to be careful with a company like this is you look at the book value, and the book value is actually pretty high. It's trading at about $37 almost a share, 36.87, and the book value they're saying is $20.22. The reason the book value is so high is they carry all these assets. The assets are actually, they're carrying it like $403 billion worth of assets, even though the market cap on this thing is only $226 billion. Are these assets really worth that much? I think they are probably counting the total value of all the money they invested in their network. They're probably marking it up even higher than that. I don't know what they're doing on their assets, but if this company were to face challenge and they need to liquidate to a competitor, are they going to potentially get this full book value? I don't think so. And so all I want to point out is we talk about book value here sometimes, and some of the companies I look at have very low book value. This one has very high book value. Just because it has a high book value, I don't necessarily think that is a selling point for investing in this type of company. I think that one thing they're doing well is just in general growth. A utility to grow this much in this number of years, 29%, is pretty encouraging. Like I said earlier, I like the growth in Latin America. I think that on a positive side of things, cell phones are the future. Everyone is using their mobile phone. Everyone is using them all day long. People need data. People need to communicate. And this is the company that provides the backbone to it all. And so I'm trying to present a somewhat unbiased, equal viewpoint here, and I know I've come across a little strong on the negative side, but what I would actually say is AT&T, it doesn't quite make my watch list, but it's definitely not a stock I dislike either. I'm actually somewhat neutral to it, maybe a little bit negative, but personally it just doesn't make the bar for my watch list, and I'll tell you why. At the end of the day, they've got some good things going for them. I like the current yield. They got some bad things going for them too. But when there's kind of a tie like that and I need a tiebreaker, you know what it comes down to? It comes down to whether I personally love a company. I like to invest in companies where I love them. I love the brand. And that's not always the case because look, Southern Company, I'm not a customer of Southern Company. So maybe if I were a customer of them, if I had hands-on experience, would I love them? Would I not? I don't know. But the kinds of companies I invest in, typically I have that warm and fuzzy feeling towards them. We've talked about this with Kimberly-Clark on my channel, for example. And with Kimberly-Clark, with their Kleenex brand of tissues, with their Huggies brand of diapers, I can tell you I have experience with these products and I love them. And that is a company that's made a difference in my life and my family's life, and I have an affinity for that brand. And so I very much invest similarly to how Peter Lynch invests and invested way back with his Fidelity Magellan Fund, in that I buy brands that I love. And look, I wouldn't say I dislike this brand. I'm just saying I don't have that affinity for AT&T. I don't love the brand. And so at the end of the day, even if there was a kind of tiebreaker, it just can't make my watch list because I just don't have that good feeling, that love for the brand. So a lot to take in today. Obviously, this is not a comprehensive analysis. This is very cursory. These are just the first screens that I did, just looking at a stock that I hadn't looked at for a while. I hadn't looked at this one for a long time. And so these are some of the things I start with. If all of this went really well, and let's say I also loved the brand, or even let's just say it came out the way it did, but I loved the brand, maybe I would dig a little bit deeper. Maybe I would be enticed to go into some of these financial statements more. But for me, I feel comfortable at this point kind of stopping here, passing it along. I already own 36 stocks. I don't need this one in my portfolio. So I'm okay stopping at this point. But like I said, if I love them, I'd probably go a lot deeper. And so if you want to learn more about how I fundamentally analyze stocks, I'm going to link to some videos below. I also have a spreadsheet on the way. I'm actually about halfway done with it, that I'm going to be sharing with everyone for free. And it's going to share my complete methodology, which is substantially more in-depth than this. And so I may be missing some things. I realize this is just cursory, but I hope it gives a flavor of how I personally think about AT&T in 2018. Now, of course, I don't know whether it's going to do well or not from here. And so just in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. This video is just for fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Also, in terms of full disclosure, I own 2 of the stocks that we discussed today. I am a shareholder in Southern Company. I'm also a shareholder in Kimberly-Clark. So I am long on ticker symbol SO and KMB. I got a lot of great comments. Recently, I surpassed 3,500 subscribers here on the PPC Ian channel. Thank you so much for everyone who's supported and all the great comments. It means the world to me. One of the comments said, hey Ian, we should leverage the resources of this community to analyze stocks. And so here is my challenge, my request to others out there. This is, like I said, just a starting point, just a quick opinion of what I think about AT&T. I would love to hear comments below. What do you think about AT&T? What are the things that you're seeing that are potentially different from what I'm seeing? Maybe I'm completely wrong. Everything I'm looking at, the way I'm looking at it is just completely wrong. And maybe this is the best stock ever for dividend growth investors in 2018 and beyond. It could be. And so please do list your comments and thoughts in the description below. Let's see what the community comes up with, because certainly this is just one opinion of many. And I know this stock is a core holding for a lot of folks out there. And look, it's gone nowhere in the last 5 years, and I like that. I like a stock that's gone nowhere because sometimes that's an indication of value. Whereas the stock's gone nowhere, their revenue is up 30% almost. And so that's kind of cool. And so anyways, I'd love to see what you guys think. Before you leave today, if you enjoyed the video, it would be so meaningful. I would really appreciate it if you could give a like, if you could subscribe, a comment. All of that means the world to me. It's the greatest way that you can thank me for producing these videos here on YouTube. Also, I'm going to link to it in the description below. If you want to engage with me and chat, please do include a comment below. I will typically try to respond to most, if not all of them. But also, I'm on Instagram now, and if you want to connect, I'm checking that throughout the day. And if you connect with me on Instagram, I can oftentimes get you a quicker response even than the comments here on YouTube. So anyways, thank you for watching. This is Ian Lopuk from ppcian.com, just with a few thoughts on AT&T stock today. And I will see you in the next dividend investing video.